Welcome to the deep dive. We're jumping straight into the third quarter 2025 earnings from a major industrial player. They didn't just meet expectations, they really seemed to smash them.
Absolutely. It was a very strong quarter overall.
So our mission today, quickly unpack why the results were so good and what it signals for their big portfolio shakeup.
Exactly. Lots of moving parts, but the core message is one of accelerating momentum and strategic progress.
Okay, let's dive in then. The headline numbers, quite a beat,
A
right?
significant beat, yes. Adjusted EPS came in at $2.82. That's more than 10% above the consensus.
10%, wow. And sales?
Sales hit $10.4 billion, also ahead of forecasts. But really, the organic growth story is key here.
Right, that accelerated.
It did. To 6% year over year, that's better than even their own high-end guidance predicted. Shows real underlying demand.
Okay, 6% organic is solid, but you always worry, is it sustainable? What about the pipeline, the future orders?
Well, that's where it gets really interesting. Orders surged. We're talking 22% growth year over year.
22%.
Yeah, and it wasn't just one hotspot. It was broad-based across all four of their segments.
Okay, so that strong demand pushed up the backlog.
Exactly. Pushed it to a new record, $39.1 billion. Huge number.
$39 billion. Can you translate that? What does that mean in terms of, like, future coverage?
It means their book-to-bill ratio was 1.1x. So for every dollar they billed in Q3, they booked $1.10 in new orders.
Right, so they're adding more future work than they're completing right now.
Precisely. It gives them fantastic visibility well into 2026, really de-risks things.
Okay, orders are strong, visibility is good, but I did see a slight drag on the margins. Segment margin was 23.1%,
Yeah, it met the high end of their guidance, which is good.
but still down 50 basis points compared to last year. What's happening there?
That's the key nuance. Operational growth is there, but there are pressures, cost inflation, some mix effects. However, it's important to note the EPS beat wasn't just about the operations.
Yeah, okay. What else drove it?
Well, segment profit growth helped, obviously, but they also benefited from a lower adjusted tax rate and a lower share count from buybacks.
So some financial engineering helping to bridge the gap while they work on those underlying margin pressures.
You could say that. Smart financial management supporting the operational story while they navigate costs.
Got it. Okay, let's shift to the outlook. This is where it gets complex, right? They raised full-year guidance again.
For the third time this year, yeah. Which is pretty remarkable.
Especially because this new guidance includes the impact of a major divestiture.
Right. It fully incorporates the spin-off of their advanced materials business, Solstice. And that spin is happening soon, October 30th.
Sooner than expected to, wasn't it?
It was, yeah. Pulled forward slightly.
Okay, raising guidance while simultaneously shedding a business unit.
Yeah.
That takes confidence. What's the actual hit from losing Solstice for the full year?
It's not insignificant. The spin is expected to knock about $0.7 billion off full-year sales, and it reduces adjusted EPS by around $0.21, trims free cash flow by maybe $0.2 billion.
So despite those specific headwinds, they're still lifting the overall targets. Let's get specific. What are the new numbers we should focus on?
The main one is adjusted EPS. New range is $10.60 to $10.70.
Okay.
Organic sales growth for the year is still expected around 6%. But, to see the real core performance.
You have to adjust for the noise.
Exactly. You need to strip out both the Solstice impact and a big Bombardier agreement from the prior year. On that kind of apples-to-apples basis, adjusted EPS growth looks like a very healthy 5% to 6%.
Right, that gives a clearer picture. And free cash flow.
New guide is $5.2 billion to $5.6 billion. Strong cash generation.
And they gave a glimpse into Q4 as well. What's the final quarter look like?
They're expecting momentum to continue, maybe even accelerate slightly. Q4 organic growth is projected at 8% to 10%.
8 to 10%. That's a strong finish.
Translates to sales of $10.1 to $10.3 billion and adjusted EPS between $2.52 and $2.62. They're clearly banking on that huge backlog.
Makes sense. Okay, let's get under the hood a bit. Segment performance. Which parts of the business were the real powerhouses in Q3?
Aerospace Technologies, AT. No question. It was the standout.
Back to double digits.
Yep, 12% organic growth, really strong, driven primarily by commercial aftermarket. That was up 19%.
So planes flying more, needing more parts and service.
Exactly. Global flight hours recovering. And their defense and space side was also strong, up 10%. That's 7 straight quarters of double-digit growth there.
Impressive consistency. And the orders in aerospace.
Book-to-bill was 1.2x just for AT, so demand is definitely outstripping current sales there.
But that's the segment where we saw the margin pressure we mentioned earlier, right?
Yeah.
Down 160 basis points year over year.
Correct. That's where the inflation, supplier costs, labor, and some acquisition integration headwinds really showed up.
So is that a major concern, or are they getting a handle on it?
Well, the key thing they highlighted was sequential improvement. Margin was actually up 60 basis points compared to Q2.
Oh, okay. So the trend is improving.
That's the signal. They seem to think Q2 was the low point, the trough for those pressures. They expect pricing actions and integration benefits to start helping more now.
That sequential uptick is definitely important context. Okay, shifting gears to the automation businesses, what will eventually be the core company after all the spins.
Building automation, BA, kept up its steady performance, grew 7% organically.
And margins there.
Margins actually expanded, up 80 basis points. That was mainly volume leverage, selling more without costs rising proportionally. Good efficiency.
And industrial automation, IA.
IA returned to growth, just 1% organic, but positive, driven by strength in their sensing business, which was up 6%, and things stabilizing in warehouse automation.
Okay, so mostly positive on the automation side. What about energy and sustainability, ESS? That's the segment with Solstice about to spin off.
Yeah, ESS was the weaker spot, down 2% organically.
What drove that?
Mainly some timing issues in their UOP business, licensing delays, lower catalyst shipments. That part of the business can be a bit lumpy, but it was partly offset by 5% growth in the advanced materials part, driven by refrigerants, and there was a one-off benefit, too.
What was that?
A U.S. government reimbursement for some past legal costs. That actually helped keep the overall segment margin flat at 24.5%, despite the UOP weakness.
Got it. Okay, so beyond the quarterly numbers, the big picture is this massive portfolio overhaul. It feels like it's really picking up speed now.
It absolutely is. The Solstice spin confirmed for October 30th. That's ahead of schedule. And financially important, the main company gets a $1.5 billion dividend from Solstice as part of that deal.
$1.5 billion. Okay, and the bigger piece, the aerospace spin, still on track.
Still on track for the second half of 2026, yes. No change there.
And this leads to a whole new structure for the remaining company, right? Focused purely on automation.
Exactly. Starting Q1 2026, they'll report differently. Simplified structure focused on the business models, aerospace tech, building automation, process automation and technology, PA&T, and industrial automation, IA.
So after the aero spin in late 26, you're left with BA, PA&T, and IA.
Correct. A pure play automation company. The idea is it creates a clearer investment story, focuses R&D, capital allocation, makes it easier to value.
Makes sense. They also made some big moves on cleaning up legacy issues, didn't they? Things that have been a drag for years.
Hugely important moves, yes. They essentially de-risked the balance sheet significantly.
How?
They divested long-standing asbestos liabilities, Bendix, and some others to a third party, basically walled off that risk. And they also terminated an indemnification agreement they had with Residio, which was another big potential liability hanging over them.
That sounds like a major cleanup. Was there an immediate financial impact?
Yes. Terminating that Residio deal actually resulted in a $1.6 billion cash inflow.
Wow, $1.6 billion cash in while also removing the liability risk.
Exactly. So it strengthens the balance sheet and gives them more financial flexibility heading into these separations. Very strategic.
And one last piece, the quantum computing venture, Quantinuum. Any updates there?
Yeah, interesting developments. Quantinuum did a big capital raise in September, over $600 million.
And the valuation?
Hit $10 billion pre-money. That's double its valuation from earlier in 2024. Shows growing confidence, in that space.
Any notable new investors?
Some big tech names came in as strategic partners. Quanta Computer, NVIDIA, adds credibility.
And the plan is still for the parent company to eventually sell its stake.
That's the stated intention, yes. Monetize it when the time is right. It's becoming a very valuable asset on their books.
Okay, so let's tie this all together. What does it mean for you, the listener? Clearly, Q3 showed strong execution, especially the demand surge in aerospace. Orders look fantastic across the board.
And the guidance raise, even with the Solstice spin complexity, really underscores management's confidence. They see continued growth ahead.
But there's this underlying question about margins, right?
Right. Management was pretty clear. This year, the strategy was sort of defensive, protect volume, manage inflation, even if margins took a small hit. But looking ahead to 2026, with inflation hopefully stabilizing and the M&A integration costs fading.
They expect pricing to become a tailwind.
That's what they signaled, yes. They expect pricing power to really start driving margin expansion, particularly in aerospace and maybe industrial automation too.
So here's the final thought for you to consider. You have strong underlying demand, shown by the backlog. You have a balance sheet that's been significantly de-risked. You have an accelerated plan for creating focused, independent companies. And now you have the expectation of pricing power returning as a major profit driver next year.
Yeah.
The question is, how much extra momentum, how much more fuel does this strategic streamlining add to that underlying growth story in 2026, especially as those temporary margin headwinds fade and investors get clarity on these new focused businesses? That potential unlock seems quite significant.